Lifetime ISAs are one of the best accounts around, thanks to two main reasons. Firstly, the fact that with this account, you can get a 25% government bonus up to £1,000 each tax year. And secondly, the fact that any interest or gains you make inside the account is completely tax-free thanks to that ISA wrapper. I myself use this account to help save towards my first-time property, and it completely supercharged my journey. However, I did make some mistakes along the way, and I could have got to my deposit goal so much quicker. So this video will be all about what my strategy would be if I opened a lifetime ISA in 2025. Lifetime ISAs can be used for two main reasons, two main penalty-free reasons. In firstly, retirement, and secondly, towards a first-time property. And in this video, we'll be focusing on what my strategy would be for the first-time property angle in using it for that purpose. To achieve this, we're going to break the video down into 4 parts. The first part will be focused on which type of LISA to use. Then we'll deep dive into the strategies. So for a cash LISA, we'll focus on which provider to use and how to always maximize interest. And for a stocks and shares LISA, we'll be looking at which provider to use and also what to invest in. Then we'll finish the video with some tips for success. If you're new here, I'm Finch, a management consultant by day, and on this channel we like to discuss all things personal finance with a particular focus on how to grow your money. If this sounds good to you, then I greatly appreciate a subscribe. But for this video, let's get into it, and let's kick off by going through how to decide which type of lifetime ISA to open. There's 2 types of lifetime ISA, a stocks and shares LISA and a cash LISA. With the stocks and shares LISA, you'll be investing. You'll be investing in assets like stocks, bonds, and funds. The way you make a return through this account type is through the assets increasing in value. You can also make a return through dividends, but asset appreciation is the main way you'll make money. With a cash lifetime ISA, this is essentially a savings account. And with this, like with any savings account, the way you make a return is through the interest rate. In terms of which one to open and how I would choose, this is really a question of whether you're looking at the short term or the long term for when you plan on using the money. Over the long term, investing has historically provided the means to grow your money faster compared to savings. For example, you can see here that if you put £1,000 in a world index fund in 2014 and left it there for 10 years, by 2024, that £1,000 would have grown to £2,675. But if you left the money in an average savings account over this period, it would have only grown to £1,106. That's a difference of a whopping £1,569. For this reason, stocks and shares LISAs tend to suit those who are looking to tuck their money away for over 5 years and are willing to take risk. However, cash LISAs will still suit many people, particularly those who don't want to take risk, as with investing your money can go down as well as up, and those who are looking at a time frame of under 5 years for needing the money. The reason why I say 5 years, as with investing, the markets are volatile in the short term in that they go up and down a lot. And if you invest in a time frame of under 5 years, you face the risk that the markets have a bad few years and you end up losing money. For example, you can see here the annual returns of the S&P 500, which is a good gauge of the overall US stock market. You can see that over most 5-year time periods, the return is positive, as this gives enough time for the market to recover from any bumps. However, in some individual years, there are some big swings downward, and this shows the risk of investing over the short term and the reason why cash LISAs may be better suited to those looking at this shorter time frame. So the 2 key factors which typically determine what type of lifetime ISA you're suited to are your risk appetite and the time frame for when you need the money. It's important to choose the right type of lifetime ISA for your needs. I personally chose the wrong type for my circumstance. I chose a cash lifetime ISA when I was actually best suited to a stocks and shares lifetime ISA. I had a time frame of 6 years. It was 6 years till I used my lifetime ISA to buy this place, and I probably would have taken some risk. I was willing to take risk. However, I opened a cash lifetime ISA. I didn't open a stocks and shares lifetime ISA, even though I could have made thousands more if I did. I didn't do this because I was scared of the risk. And to be honest, I opened a cash lifetime ISA because this was the easy option. I understood this better. I was born and bred using savings. In the UK, we're born and bred knowing how to save money in a savings account. We're not born and bred in terms of how to invest money in an investing account. And I went with the easier option instead of doing research and watching a video like this, which could have led me to opening a stocks and shares lifetime ISA and then making thousands more and getting to my deposit goal even quicker. Of course, this is just my personal circumstances. In this case, I was better suited to using a stocks and shares ISA, but your needs and circumstances will be different to mine. So make sure you do plenty of research to determine which type of ISA you're best suited to. You do still have the option, if you're undecided, to use a combination of both, in both the cash and the stocks and shares variant. But hopefully either way, you have more knowledge now by this point in the video on what type of ISA you're better suited to, even if you've not made that final decision. So let's now move on to the next part of the video and going through the strategies for each of these ISA types. And let's start with the cash variant. In terms of how to decide which cash lifetime ISA provider to use, the biggest determining factor is the interest rate. To compare interest rates for different providers, the easiest way to do it is going on to a comparison website such as Money Saving Expert. We can see that according to Money Saving Expert, Plum is offering the highest interest rate at the time of recording at 4.22%. So if I was opening a cash lifetime ISA right now, based on current rates, I'd go with Plum. However, it's important not to just sit tight and keep with the same provider the whole time period you have a cash lifetime ISA. It's important to check that you're getting the best rate every year and consider switching provider if you don't. Rates regularly change, and providers like Plum and Moneybox typically boost your first year rate with a bonus. For example, at the moment, Plum's 4.22% rate includes a 0.86% bonus, and this only lasts for the first 12 months. So if I did go with Plum, after 12 months in this scenario, it would make sense for me to review the rates in the market and switch to another provider if I can get a better rate elsewhere. So if I was opening a cash lifetime ISA today, I would firstly go for the highest rate provider today, but I wouldn't just sit there with that provider for the duration of my cash lifetime ISA. Every year I would check interest rates and I would switch providers if I could get a better rate elsewhere. So now we've gone through the strategy I would take if I opened a cash lifetime ISA as of today. And let's do the same for a stocks and shares lifetime ISA. In terms of how I would decide which provider to go for, this would require a bit more thinking in understanding which platform best suits my investing needs. The criteria I would use for this is firstly making sure the platform has what I want to invest in. Secondly, making sure the platform has low fees in terms of investment fees. And thirdly, making sure the platform is easy to use. I previously did a video comparing several platforms across this criteria, and the two standout platforms from that video were Moneybox and Dodl. AJ Bell Dodl has the lowest fee structure I'm aware of for stocks and share ISA providers. There's no dealing fees, and the annual platform fee is just 0.15%. You will need to pay fund fees if you want to invest in funds, but you'll need to pay this on any platform. With AJ Bell Dodl, there's also a good selection of investments in terms of stocks and funds, and the platform itself is really easy to use. It's all within one app. For Moneybox, there is a similar investment choice, but their platform is slightly more expensive, with a 0.45% annual platform fee and a £1 monthly subscription fee. However, in my view, Moneybox provides the better user experience, particularly for beginners, and it has more features which help you save. If you want a larger investment choice than what Dodl and Moneybox can offer, then the likes of Hargreaves Lansdown tend to suit, although beware as these platforms tend to have more expensive fee structures. For me personally, if I was opening a stocks and shares ISA right now, I'd likely go with AJ Bell Dodl for the simple reason that they fulfill my criteria, in that they're low cost, they have what I want to invest in, and I've tested out the app and I've found it fairly easy to use. Of course, my needs will be different to yours, so again, do your own research. After determining the platform I'd use, the next question is determining what I'd like to invest in. For this, I'm not a financial advisor, so I can't tell you what to invest in, but what I can do for this video is go through what I would invest in if I was opening a stocks and shares ISA right now. Choosing what to invest in for me is a risk versus reward question. The high risk approach is to buy individual stocks to try and get the highest return possible. It's extremely tempting to go with this approach, to buy individual stocks and just buy the biggest companies in the world in Apple, Microsoft, Nvidia and so on. On paper, this seems like a perfectly valid approach, as these companies in recent years have seen significant growth and outstripped the general market. However, just because these are the biggest companies today doesn't necessarily mean they'll continue to be so in the future. History tells us this. Plus, more generally, it's incredibly hard to stock pick, and various studies have found that most people who do stock pick lose money. When I began investing, I was in this boat. I thought stock picking would be easy. I thought this was the way to make big bucks. Buy low and sell high with stocks. But I actually ended up losing money with this approach. Even the professional fund managers find stock picking tough. These guys are meant to be the experts, but year after year, most actively managed funds underperform the general S&P 500 index. For example, in 2024, only 35% of funds run by these experts outperformed the S&P 500 index. Given this, buying individual shares tends not to suit beginner investors as it's high risk. The good news is that investing in funds offers a lower risk investing approach. The big benefit of funds is diversification, meaning that you're not putting all your eggs into one basket like with stock picking. Instead, your money goes into a range of investments, saving you the need to pick individual investments you think will do best. Think about it this way. If buying an individual share is like backing the star player of a football team, buying a fund is the equivalent to picking the entire squad. The specific type of fund I personally would focus on if I was starting now would be a global tracker fund. The reason for this is because these funds maximize diversification. They do this through providing exposure to thousands of companies across most countries in the world in both developed and emerging markets and cover nearly every sector. This means that if one country or sector doesn't do well, you have others to fall back on. You may be thinking though, well, why don't you just invest in a fund which focuses on US companies, such as an S&P 500 tracking fund, as the US is the biggest stock market in the world, and it's recently made much larger returns than the general market. However, this trend hasn't always been the case, and it could be a risky approach to bet on this trend continuing. We can see here that for much of the 1970s, late 1980s, and early 2000s, the international markets outperformed the US. So history suggests that US and international market outperformance tends to move in cycles. Since 1975, these cycles have averaged just over 8 years. We're currently around 14 years into the current cycle of US dominance, so international stocks could be well overdue their day in the sun. And global funds provide that exposure to international stocks in case they do. They still do have a tilting towards the US market, since global funds have over 60% exposure to US stocks, so if US stocks continue to outperform, you have exposure to that as well. With a global fund, I'm not betting on a single sector or single country doing well. Instead, I'm betting on the whole damn market, and this helps reduce risk. Sure, I won't 10x overnight on some stocks. You can do this with some stocks if you get lucky, but my approach with this isn't about gambling. My approach, my strategy, is about long-term wealth creation, and global funds help with that. Historically, global funds have averaged over the long term an annual return between 7 to 10%. The platforms we spoke about earlier in Moneybox, Dodl and Hargreaves Lansdown all offer global funds, and the most diversified global funds typically track the MSCI ACWI index or the FTSE All World index. The reason why I mention these two indexes specifically is because other indexes can be limited to developed markets only, whereas these indexes cover both developing and emerging markets, making sure you get diversification across nearly all countries and sectors. An example fund following one of these indexes from Dodl would be the HSBC FTSE All World, what Dodl give a nice nickname of on top of the world. It's worth knowing that these funds are of course 100% equity funds. They only invest in stocks. And if I was a little bit cautious about investing in only stocks and wanted to reduce the risk level slightly, I would likely also invest in a bond fund alongside this global fund, as bonds typically are more stable and lower risk compared to shares, but they also offer lower return. So I would likely decide on a percentage split between bonds and shares depending on my risk appetite. Some platforms actually make this super easy by having ready-made portfolios with different percentage splits between bonds and stocks. For example, Moneybox have a starting option portfolio choice of 3 different risk levels, and Dodl have something similar in using Vanguard's life strategy funds. But for me personally, I would likely just go with a single global fund, as I'd be willing to take more risk if I was starting again right now in 2025. Now we've gone through the strategies I would take if I opened a cash or stocks and shares LISA right now. Let's move on to the final part of this video and going through some tips. The biggest tip I would have based on my own experience is having a clear deposit strategy where you're consistent, well in this case I'm consistent with my deposits, enabling me to get the most out of that bonus every single tax year. Most lifetime ISA providers allow direct debits, so you could automate the whole deposit process. And what I would do is I would automate my deposit process and I would ensure my direct debit was sufficient to get the most out of that bonus, which means I would need to deposit £333 or just over £333 every month to reach that maximum allowance of £4,000 and get the full £1,000 bonus from the government. Of course, not everyone is in the boat to max out that allowance, and if you can put anything into your lifetime ISA, you'll be doing well and you'll still be making some headway in getting a bonus. A final tip I would provide myself there if I was starting now is luckily something I actually did myself, so it's not a mistake or lesson learned, and that's finding a deposit partner. As if you can find a deposit partner where you're moving into a property together, whether that's someone in a relationship or just a friend, then you can supercharge your journey even further. And that's because you'll both be eligible for that LISA bonus. So if you max out your account yourself and get the full 1k bonus, you can do that, but also your deposit partner can do that, meaning you can get a 2k bonus between you each tax year. Fortunately, I did this with my own partner and this really supercharged our journey. So that's the final tip, and that's the last part of this video in going through what I would do if I was starting my LISA journey today. Hopefully this has been useful, and if you have found it useful, then I'd greatly appreciate a like or subscribe. If you plan on using Dodl's platform for your lifetime ISA, then they actually have a great welcome bonus where you can get a £30 voucher if you sign up, meet the terms and conditions, and fill out this referral form. And I have all details for this in the description of this video. Thanks for watching.